Welcome to Echo Trade. This is Jeff Roth, and I'm here with Tom Carroll from Catholic Investment Strategies. And today we're going to talk about their Catholic Values Dividend Growth portfolio within Echo Trade. A little background on Tom. Tom's coming to us from Wisconsin. It's probably beautiful out there right now. I wouldn't want to be dealing with the winters, but Tom's got, I think somewhere close to 35 years experience, portfolio manager, 26 years at Mason Street Advisors, part of Northwestern Mutual, and across a few different funds was managing, about $4.25 billion in assets. So no stranger to large amounts of capital being entrusted to him. But again, we're talking about the Catholic Values Dividend Growth portfolio. So Tom, appreciate you being here. Excited to kind of learn a little more about the portfolio.
Thanks, Jeff. I'm happy to be here.
Yeah. So let's dive in. So, first off, I think there's a lot to unpack, but I think first I just kind of want to get specifically talking about what are the goals of the portfolio in the sense that, are we looking to track an index while we're minimizing downside risk, or are you looking to outperform? What's the specific goal of the portfolio from a monetary perspective?
Well, we tend to track portfolios versus relevant benchmarks. So for this one, it would be using the S&P 500 dividend index.
Yep.
The idea is to get a mix of both capital appreciation and dividend income.
Gotcha. And so if you can give then, so I appreciate the kind of specificity in terms of the goals. Can you kind of give a quick overview of the portfolio and the philosophy behind it?
Well, when you're dealing with dividends, to us, the primary thing is trying to make sure that your dividend is actually going to get paid. So the quality of the company is very, very important. So we limit this portfolio to companies where we believe the dividend paying ability is above average, in fact, well above average. And then, of course, it has to be paying a dividend. So but we don't put a downside limit on the dividend. We tend to build I shouldn't say we tend to build, but we have built an indicator where we combine three factors, one being the yield, the second being that quality. We quantify that number or that capacity into a number, and then there's a growth number, and we combine those three things to give them each company a score.
Okay.
Based on that score, then that's how we actually weight the various positions.
Okay. And is that also how you would then kind of, filter out and screen, a handful of different companies that you're looking at to determine what's actually going to go in the portfolio? So that's part of the investment process as well?
Yes, that's right.
Got it. And so, I know you guys have, is that the proprietary scoring system that you referenced before?
Yes.
Got it. No, that's helpful. I guess I want to kind of dive more into that a little bit more specifically, but as this is a Catholic Values Dividend Growth strategy, unique to the portfolio. When we first started talking, I was really excited to be able to have a faith-based portfolio within the platform. So can you talk about, how that differs from other portfolios and kind of what that entails in terms of, making sure that you're investing along with the Catholic faith?
Certainly. So we build everything according to the standards laid out by the U.S. Conference of Catholic Bishops. They, at the end of 2021, put out a new version of their socially responsible investment guidelines. So that entailed a few changes, but basically the bishops are asking you to do two things. One is to avoid the really bad actors. So companies that are involved in abortion, for instance, pornography, weaponry, but also what they want you to do, and this is where we're different than the vast majority of other managers who tell you that they're going to give you a Catholic portfolio, is the bishops want you to be advocates for change at companies that you can invest in, but where something they're doing isn't quite up to snuff. So there's an example that's a bit long in the tooth, I guess, at this point, but it's interesting nonetheless.
Let's hear it.
Back in the day, Nucor Corp, I don't know if you're familiar with them,
Mm-hmm.
but they're America's largest steel company. But
Mm-hmm.
they operate differently because they remanufacture steel from scrap steel.
Yeah.
And as part of that process, they have to import from Brazil one of the raw materials. And it turned out that the Brazilian suppliers were using slave labor.
Mm.
And after some work with management, they got on board and put a vetting process in place so that they could screen out anybody who would be doing that sort of thing from their purchasing. And then, to their credit, they took it a step further and they joined an organization down there that is dedicated to stamping out slavery in Brazil. So it's a happy ending. I mean, it's a great thing.
That's incredible. So you're not only, hey, so we're like you said, we're hard line eliminating these companies, but companies that are stepping out of the bounds, then you can be an agent for change within that company. And then, if they don't follow, obviously, then I would imagine then they're going to be cut out of the portfolio, and we're no longer going to be investing in that. But you're an agent for change for the good, not only just saying, hey, we're allowing you to invest with your Catholic faith and those values in mind, but being an agent for positive change in the companies that are would otherwise be in the portfolio.
Exactly right. Yes.
That's fantastic. That's great. So I guess kind of diving in a little bit more on just the investment side, can you talk about, what we're investing in specifically? So it sounds like we're investing in individual companies, or are you investing in ETFs as well?
Okay. No, it's all individual companies.
Mm-hmm.
And we built this portfolio. You mentioned how in the past I used to run a fair amount of money for Northwestern, but we built this. What we did there, and which we also do here, is rather than look at market caps. Everybody likes to build portfolios based on market cap.
Uh-huh.
We look at average daily trading volumes, because if you need to buy or sell something, that's really what's important, because you don't want to be moving the market when you're getting into a stock or getting out of a stock. So that's one thing that's important to us.
Mm-hmm.
We're looking at companies that have a history of no dividend cuts in their past. So they've exhibited a commitment, to paying a dividend.
Mm-hmm.
And then this is really the starting point. We're looking for valuation. So we're trying to focus on companies that are pretty steeply undervalued.
Yeah. Are you looking at then, so within that criteria, are you looking at specific areas in terms of industries or sectors or geographically, or are you pretty agnostic and looking for opportunity wherever you can find it?
We're focused on the value, really.
Yeah.
And the sustainability of the dividends. So all these things, mix together and play together. And as far as the concentration on a sector or a geography or an industry, whatever, that just falls out. We don't try to control for that.
Gotcha. So you're not saying, hey, we want to be exposed to every sector, or we like this certain sector, or this, we want to be involved in emerging markets, or we want to stay in the US. You're that's not involved at all in the investment process. You're purely looking on an individual company basis, bottom up, and determining what, making sure that the value is there to invest there. And that's your primary and singular focus.
It's the starting point.
The starting point.
But all those other things I talked about, those are also very important. And I want to make one thing clear. So we're only investing in U.S. companies.
Okay.
And only those that trade on the major exchanges.
Yep. So,
that's a limitation without being restrictive.
Yeah. Gotcha. Absolutely. So, I mean, I guess part of that, only U.S. companies, you're not, looking at emerging markets, which can be a little bit more volatile, I would guess. So what are you guys doing in terms of, how are you guys looking at risk, would you look at this as a more conservative or a more aggressive portfolio? And what are you guys doing to kind of, mitigate risk on an individual, position basis? And then on the broader term, to kind of, mitigate, exposure maybe to corrections and bear markets?
That's a lot of different items to talk about.
Sorry. Well, I guess you can pick one there in terms of just broader, market risk. How are you guys identifying that?
Okay. Well, this is an equally weighted portfolio. So we're not, going out on a limb and putting huge bets on in any one name. So that's one thing. We actually refresh this portfolio every month. So, if a good thing happens and a stock goes up a lot, we're actually going to cut it back. So we harvest some of those gains. So that will reduce the risk. Because of what I mentioned near the beginning about focusing on companies that have the wherewithal to keep paying or increase their dividends, we're taking out some of the financial risk from the company itself. So all those things. And then again, the focus on companies that haven't cut their dividends, there again, that's a risk reduction item.
Yeah. And so, with all that in play, in relation, risk is a relative term, but in relation to, an all equity portfolio, would you say this is a more conservative or more aggressive portfolio?
I would say it leans conservative.
Okay. Sounds good.
We tend not to have the super high multiple companies.
Yeah.
Right? But to be honest, so far this year, certainly that's what the market's been in love with. And I think I read something just the other day where 90% of the S&P 500's gain so far this year is from 7 companies.
Yep, exactly. So you're not always going to be able to pick those, the 7 high flyers at any given time.
No. This is, the old saying, it's a marathon, not a sprint. So
exactly. And that goes into kind of, one of the last questions in terms of the timing of the portfolio and the time horizon. So this is, you're looking at a long-term time horizon. Like I said, you guys are updating the portfolio on a monthly basis, but, you're looking at longer time horizons to be able to really see the value of the portfolio. You're not looking to make some quick gains in 6 months. This is a longer term portfolio.
I want to contradict what you just said just a little bit.
Okay.
Because what we're doing is we're trying to focus on that undervaluation.
Yeah.
So if that reverses could be a month, it could be 3 months, it could be 6 months. And in the meantime, other things have become more attractive, we'll swap out. So really, we're kind of time horizon agnostic.
Yeah.
A lot of things can happen. For instance, you can buy, let's say Verizon. I'm just picking that one out of the air because it's topical. Where companies got a good history of paying dividends, of raising dividends, of a good financial picture, and then out of the blue, suddenly, they might be in trouble with lead poisoning from their cabling. So what can happen is that while a number of factors are still positive, suddenly that dividend safety, and I'm not saying that this is the case, but that dividend safety number can go to a point where it's not acceptable anymore.
Yeah.
So there's lots of things that can cause turnover in the portfolio. And we just, like I said, we try to stay true to the philosophy behind the portfolio and just keep putting what we perceive to be the best, opportunities into it.
Yeah. You did mention that earlier that, you could, see a quick gain in an individual position, and you're going to capture those gains. No, okay, that makes sense. But overall, you're time horizon agnostic. You're just going to see what the market is telling you, what each position is telling you based off of your proprietary models. I guess finally, if you can just kind of let me know from your perspective how you see this portfolio as different. I mean, within the echo trade environment, which is primarily mostly all equity portfolios, but then also broadly speaking, you guys have offered like you said at Northwestern, you were managing a handful of different types of portfolios, and then also today. So why this portfolio for echo trade? What makes this portfolio different, and why do you think it would be a good fit for echo?
Well, number one is it gives your subscriber base an opportunity to invest in a Catholic fashion if that's what they're after. And our history with this portfolio has been good. It's been a very strong portfolio, and it God willing pass as prelude, but of course we can't use that in this business. But we would expect that we'll be producing capital gains, nice capital gains, along with a healthy dividend income. And, that's pretty much what people invest for, at least in my world. So,
yeah, no. I mean, when we first started talking, like I mentioned, I was really excited to be able to offer, a faith-based portfolio on the platform. And so, it's not always that every portfolio is going to align with those values. And we all have to put our money to work to secure our family's futures and to be, as generous as we can with what we were blessed with. But, it's not always in line with what we're called within our values. So I'm excited. I'm thankful to have you on the platform and have a faith-based portfolio for investors to kind of invest along with their values and their faith. So thanks for being here, Tom. I appreciate the time.
Well, Jeff, thank you. It's been a pleasure.